Okay folks, we will get started and welcome everybody to a Sydney Business Chamber online forum. We've been doing these for a while now. We do very much now enjoy these, and we've now moved to video. So it's one of those things where we can have, at social distance requirements, people with us, which means that those who aren't able to join us, your colleagues and associates, may be able to come back and view the video post this particular live forum and discussion. But I noticed we've got a really great audience today, vast numbers, but also across sectors. So it is fantastic to see you all here. Today is very much focused on infrastructure, and I feel that's almost like the topic of the last number of months. It's been very much infrastructure that people are looking to both have the economic conditions recover and go back to an element of, I think, economic prosperity that we all really want and aspire. And I'm sure many of you are aware that it was even the Reserve Bank governor last week came out and said states across the country need to be spending more on infrastructure, some 48 billion extra for the state of New South Wales. A big ask, but I think I saw the Premier's response was she was open to doing those things, and then it's up to people like yourselves and the people that we have with us today to actually get some of that to actually happen and be delivered. Now, this session today is the first part of two. We've decided to focus very much today on the financing and funding aspects of infrastructure, and then moving across to the 31st of August, we're going to look at more the delivery aspects, and we have some great experts coming to join us. But I also do want to thank our panellists for coming today. So for those who don't know Simon Nicholls, it is fantastic to have you here, and from Pacific Partnership. And also Marie Vinnell, thank you from Societe Generale. Both of you are intricately involved in infrastructure in different ways, but it's always taking people like yourselves to share some of your insights that make these sessions really valuable. So thank you. I also want to thank Procurement Australia. They're our digital partner, and they've been very much instrumental in bringing you both the podcast today and the video. So thank you again. But why don't we kickstart today? Infrastructure, and you guys live and breathe it. It's fantastic when we were having a session beforehand, the different insights that you bring, but it all comes together. So Marie, starting with you, we know that COVID has impacted our lives, our work, the economy, but also impacted financial markets. What are some of the insights that you have as to how it's been a bit of a disruptor to the work that you do?
Sure, happy to provide our perspective, and thanks for having me join the panel today. By way of background, Marie Vinnell, I'm the head of infrastructure for SG or Soc Gen as we're known for Asia Pacific. We act as both financial advisor and lender to infrastructure projects in Australia and of course globally. Specifically in Sydney and New South Wales, I won't name them one by one, but suffice to say, ports, toll roads, desalination plants, trains. We really cover a broad range of financings across the infrastructure sector. It's been an interesting time in the debt markets, as it has been more broadly. We saw funding costs spike dramatically in March and April. I think different banks saw different impacts, or different financiers saw different impacts, but in the range of 0.5% to 1% is I think the general range of impacts. Now, whilst that may not sound like very much, from the base that we were talking about, that's a dramatic increase. That has since tapered quite dramatically as well. Probably not back to the levels sort of pre-COVID. We're still slightly elevated, but has certainly seen a sort of positive trajectory back down. What was driving the increase? Well, we saw many companies, many borrowers look to shore up their balance sheets, additional liquidity, a lot through bilateral loans. and additional liquidity requirements given the uncertainty. So a sort of, flight to quality and a flight to support our key clients, and that drove a lot of the activity. But importantly, the markets definitely remained open. I think and certainly the markets that we participate in. But we did see obviously an increase in cost and a reduction in tenors. So we were seeing tenors go out to beyond 20 years and certainly quite long in terms of where we've seen tenors in Australia in recent years, and certainly since the GFC. That's come right back in. We were seeing in the early days of the crisis or of COVID, 1 year, 2 years. I think we're edging out again to the more standard tenors of 5, maybe 7 years, but still sort of constrained in terms of where we were pre-COVID. And I think the last comment I'll make is that we're seeing something of a bifurcation in pricing and terms. So for an investment grade credit, call it BBB, we're seeing quite a bifurcation in pricing. So whilst we might have two borrowers who are rated at that level, one that hasn't been so impacted by COVID is likely to be getting much better terms and pricing at this stage, whereas those more impacted are still seeing sort of more elevated levels of pricing. So they're some of the main aspects we've seen since the emergence of COVID.
Yeah, and I think it's fantastic, but I think the big take out there is like the markets are still open, they're still doing things. Just, the layout's shifted a little bit, but it's definitely there, and we've got to think about those sorts of things where it's coming to how we go to from here. But we'll get into a little bit of that in terms of the risk and the certainty. But maybe just in terms of opening for you, Simon, really in your role at Pacific Partnerships, you've been somewhat a bit of a champion around PPPs, and I'm just thinking, has there any thoughts or even feedback from some of the people you're dealing around that model, particularly how it may or may not be applying here and now or in the future?
Yeah, no, thanks, Catherine. It's a really interesting question, and as you said, we, particularly at Pacific Partnerships, have been an advocate for the PPP model, and I think that's because as we look at the future, I really hope that privately financed projects play a really important role, just as they have in the past decades for our city-changing complex infrastructure projects. Part of the reason for that is I think privately financed projects, or particularly availability PPPs, are still among the most efficient and effective outcome-focused delivery models that we have. And that's because they're structured to define a level of service that has to be achieved throughout the life of that asset, and defines the condition that you're going to hand the asset back at the end of the term. So it really is less about the prescriptive nature of the infrastructure and more about the service that you're actually achieving, which is really the point of infrastructure. It's not the infrastructure itself just for infrastructure's sake. It's about the service that you're delivering. It's about the outcome you're delivering for the society. And that's why infrastructure is so important. And I think in addition to that, the PPP model, it brings rigour, it manages those interfaces, it allows government to still be in control, and I think really importantly, it's a model that enables that full whole of life consideration. It's not just about the lowest capital cost, it's about what's the lowest cost over the term of the asset, and it allows that optimisation. And I think with that comes the innovation, which is really critical. And I think then if you do look at parties that are integrated, then you can actually get true alignment to mitigate those risks in the bid phase, but then also a way to identify and resolve issues during the delivery and operations phase. Interestingly, earlier this year, IPA commissioned a report, and they did a study into the outcomes on social infrastructure over the last 25 years and looked at PPP as a delivery model and how they actually performed. The outcomes from that study were quite interesting, and what they found was that 95% of the cases, the service levels were achieved. And what they found is very high levels of satisfaction with the model and with the service that was achieved. And that correlated with 95% of those parties preferring PPP over traditional procurement methods. And that was a demonstration of the value of PPPs in the social infrastructure space. It effectively allowed the operations to get on and operate their facilities rather than having to worry about the quality of the asset. It defined that level of service and it ensured it was there right till the end of the contract. The model did what it was meant to do.
Yeah,
And
you jump in anytime.
Yeah, and I can add to that. I think certainly in relation to operational PPPs during this period, they've held up very well, performed, remarkably resiliently, done as they're set out to do. I think, of course, projects in development and projects in procurement, face some additional challenges in the current market. But I agree with Simon. The PPP model, in our view, continues to be absolutely an appropriate tool for procuring authorities to pursue city changing, city building projects.
And how does that relate? You were mentioning earlier about, Simon's mentioned the life of the asset, and then you still have sort of the duration of the financing structures you put in place. Are they aligning at the moment? Is the PPP model sort of still enable that? Are they in sync, I guess, is what I'm thinking about?
Yeah, they remain in sync. I think we're certainly seeing an evolution on some aspects of the transactions. I know we're going to talk about risk allocation, and perhaps that's a good segue. But I think the shifting market conditions have just led to some innovative and nuanced way of dealing with things. So, for example, in relation to commitment periods. Procuring authorities generally require 180-day validity periods for tenders to provide certainty over the evaluation period and until a project reaches financial close. In these markets, that's clearly more challenging. 180 days, 6 months, and so what we've seen is that come in from a lender's perspective to something shorter, a month or two. And then provided markets remain sort of stable, rolling those commitments, but it does give the latitude, I guess, to adjust in the event that market conditions change again dramatically.
And I do want to move into that risk component, that risk allocation and pricing that risk. And it's, so Simon, even from your perspective, there's some views, whether it's around the PP model or other models, around how do you get that right? How do you start thinking about the risk allocation and to do what you've said there is drive the outcomes focus rather than some of the more internal, introspective way of looking at the project. And
it's a really interesting point, and it's an issue that it's not just contained to privately financed jobs. I think the issue that we face is an issue that our industry faces more generally. I mean, there's been a lot of commentary about the infrastructure boom and more recently even more commentary about the profitless infrastructure boom. An infrastructure boom where construction companies are really finding it tough across the board, and it's not just for PPPs or availability models, but I think privately financed jobs are probably more susceptible. And the susceptibility is because of really the pendulum swing of risk. And that pendulum has swung further to the private sector, so that it's more of those unknown, uncontrollable type risks, those risks that the private sector can't control but has to put some kind of price around. And that's really where projects come unstuck.
There's always a role for private finance to play. I think particularly in the current constraints. I think in terms of risk allocation in relation to financiers, financiers have sort of moved with the contractor market really. I would echo Simon's comments about the sort of pendulum in relation to risk allocation. I think that clearly hasn't always produced the best outcome. Where we've had a situation where procuring authorities have been able to, quite forcibly set an expectation or a requirement in relation to risk allocation that isn't necessarily, sufficiently nuanced to reflect the specifics of the project at hand. I think we're seeing evidence of that evolving, partly due to to market conditions, contract market conditions, partly due to challenges encountered on projects already. So we're seeing, I think, a more detailed discussion, which is of course the first step to seeing that shift, whether it's in relation to utilities, contamination, ground conditions, and those things. So there's certainly, from one step removed from a finances perspective, there seems to be greater engagement on those issues. And of course, we have to mention the new hot topic around risk of pandemic. And ongoing, dealing with the ongoing situation in relation to COVID.
Is there room for this wonderful world of innovation?
Innovation is really important. It's always important, and innovation is always the way that you actually win are successful with projects and you deliver effectively. And I think innovation is best where you've got a framework to work with.
In the US university or college sector, which we've seen emerging as a PPP asset class, actually. So we've got a couple of things going on. They're typically structured around the refurbishment or improvement and ongoing maintenance of things like heating, cooling, water, sewerage. Just to name some examples. And so in addition to using private sector knowledge and expertise, private sector financing, they're also getting a solution that improves energy efficiency, that and helps universities reach their emissions targets, which of course is a topic in Australia as well, specifically for universities.
Innovation for innovation's sake is pointless. Innovation to solve a problem is fine, but we need to understand what that problem is. Now, I'd kind of argue that I think some of the problem is the underlying risk profile. So if we can solve the underlying risk profile, then we don't necessarily have a need for innovation except for continuous improvement. I think one of the big opportunities that we have is certainty. I think throughout this pandemic, one of the key challenges we've faced is not just the pandemic itself, but it's the uncertainty that it brings. Infrastructure has been able to be a real stabilising force over really the past year. Infrastructure has been able to keep going in New South Wales, which is great, and I think it can continue to be, but I think it's that certainty. I think the privately financed bring with them a level of certainty. You have something's defined, the level of service is defined, but I think the key challenge is going to be the level of certainty that we can have in terms of the timing, the scope and the procurement model that'll help the private sector to plan. There's a level that government has to play in defining and bringing things together to enable innovation, and I think that is definitely true. Some of the scoping and the requirements and the planning still does need to sit with government.
Look, there's no doubt in terms of disconnect or in fact whether it's distraction at the moment. We've certainly grappled. I mean we've been possibly more active in Victoria on projects in recent times, and there've been some challenges there in terms of the sort of level of distraction and other priorities. I think in terms of procurement, which is maybe not exactly the point that was made, but certainly something that we're seeing. I think across the board it's been a good story, and I think that augurs well for future potential asset recycling as well. I mean, we've seen the land titles businesses broadly, and there's been a number of those in Australia now. They've also been resilient. Of course, the utilities, the regulated utilities, less impacted, also performing very well.
There still is a good case for greenfield assets. So we're talking about brownfield assets, but I think we're talking about greenfield assets. There's still a need. There's still a need for new assets, and I think when we look at that, that's where I think private finance has a part to play in the role for those greenfield assets going forward. And there still is a requirement across a number of different sectors for those greenfield assets.
And thinking about different asset classes, and we local government have a huge amount of infrastructure, and it's usually held in such fragmented areas because you've got the different council jurisdictions. And it wasn't long ago when we had Stephen Walters, the chief economist, in your chairs today, and he sort of said, we've got big infrastructure projects which are great, but there's a huge role that local government can play in getting the smaller projects out and about. But there's a lot more constraints around how they could finance and fund that. Have you been involved in terms of thinking about the role local government can play in packaging up some of their requirements, maybe across jurisdictions? I don't know. Are there some constraints from a financing or a funding or a project perspective?
I mean, I've got a few thoughts, but I mean, less directly from our perspective, but I think we're seeing it begin to, emerge. There's by way of example, waste management procurement process in Victoria, where a number of councils are joining together to create a critical mass of. Part of the pun, critical mass of waste, for processing. So that's early days, but that's an example that we're seeing. We've seen. Admittedly, we're less connected to financing of local councils in Australia, at least to date. But in other jurisdictions, and like Auckland City Council comes to mind, for example, a significant issuer in their own right in terms of capital markets finance, but also. Really at as I understand it, at the leading edge of some of their sustainability efforts as well. So there's certainly examples to draw from, even if I'm not best placed to sort of discuss them in detail. Anything on you?
Yeah, no, definitely. And I think, as Marie was saying, I think that the waste sector is something that is very pertinent at the moment. We do need to do something with waste, I think, and there's been a lot of commentary around energy from waste facilities, which, I think we do need to get a more mature view. As a country, we process waste at a much lower percentage than say Europe, and I think there's a huge opportunity there. With state governments, you typically have a good counterparty that you're dealing with, so you can get very good terms. I think with councils, sometimes that can be a little bit more tricky, so maybe it's a group of councils, or maybe it's guarantees from state government that may need to come into it. And I think we do need to think about scale. I think when you look at a privately financed deal, if they become too small, it doesn't become particularly economically viable, so I think you need a certain scale. But definitely a really interesting space, and I think that's definitely the kind of thing that we need to think about going forward in solving some of those problems for councils, and getting a model that's going to work well, that can be replicated. I think that's definitely something we're very interested in looking at.
Yeah, it's a good question, and thank you for bringing that up. Our organisations actually work together on the SRU projects in Victoria, and for those who aren't aware, they were cancelled at a very late stage, which is of course unfortunate for all, for all market participants. Around debt and equity, our thinking is that, we'd seen a number of projects successfully procured and hitting financial close with increasingly differentiated financing structures, including US private placement, including long-term financing solutions. I think when you have a run of successful projects and financings like that, each one can build on the prior one, and we'd certainly look to do that for suburban roads, and provided a committed bid along those lines. And I think when you have a cancellation, you see the reverse occur, which is the momentum that you had, whether it's with debt or equity investors, in this case debt. We do expect to see investors, banks asking questions around the certainty of procurement. But at the same time, fundamentally, it's still infrastructure in Australia. So expect to see still a very solid body of support for the projects. I think at the edges, we might see some players, not necessarily opt out, but certainly be asking more questions around certainty. I think typically Australia and Victoria, New South Wales in particular, have been seen as providing a steady pipeline of work and with a good degree of visibility and certainty. When you take that away, of course, it's you end up with, or you're likely to end up with possibly a more expensive solution, a less innovative solution, or just frankly less parties interested, which isn't for the benefit of the process. But have we seen any lenders leave the market? No. Have we seen wholesale appetite in terms of volume reduce? I'd say no. So still very strong fundamentals, but I think at the edges some questions or impact on sentiment around some of these projects. I'm not sure, Simon, if you've got anything to add to that.
I mean, I'd probably say that Australia has been an attractive market globally because we have had a strong pipeline. And we have had stability and we have had that certainty. I think the risk at the moment is if we lose those, then we lose the attractiveness. So the attractiveness of international players wanting to play in this market is just par for the course when you've got an attractive pipeline.
Yeah.
Which I think speaks to the competitiveness, as Marie was saying, of the solution. So I just think it speaks to the need for continued certainty and confidence around our procurement and the structures in terms of that pipeline going forward.
Yeah, and it is interesting, and I'm trying to pull a couple of threads that you both have touched on, and throw a question to you both about climate change. We've talked about risk and risk allocation. We've talked about different asset classes or emerging asset classes. I think sometimes we're so consumed around the pandemic risk. Are the markets still thinking about the climate change risk? Is that something still being factored into how we get projects happening? I don't know if you guys are probably doing a fair bit in that area, even from what you were saying earlier.
Oh, absolutely. I think we like to think of ourselves as the energy transition bank, but I'm sure we're not alone in that in that regard. Certainly, hugely active in the renewable sector, although it's not my specific area of expertise. But we're seeing, the comment I'd make is we're seeing a real blending of the lines. So we see Transurban focused on sourcing some of their energy from renewable sources. Mining companies focus on renewable sources of energy to offset or indeed power their activities. So absolutely, it continues to be a massive focus, if not an even greater focus in the current context. We haven't seen a shift away from that in the context of market disruption. In fact, I think people are leaning in to use, to use Sheryl Sandberg's phrase. Yeah.
Yeah. From your perspective, has it changed? Is it just less of a priority, or it's just embedded in the work that you do?
Maybe a couple of things. In terms of the issues facing the world, I think in some ways the pandemic has overshadowed the climate change in the short term at least. It doesn't necessarily mean it's not there, and I think, as Marie was saying, I think the energy sector and what we do about our energy sector is a topic of another panel talk all of its own. And I'm sure we could talk a lot of time about that. And I think there's still appetite for investing in that. There's still appetite for looking at what we're doing. In terms of how it affects the risk profile of the existing jobs, probably not seeing that as much in terms of the changes to the risk profile, but it's more the nature of the projects that we're involved in, and the nature of what projects people are wanting to invest in and things.
Yeah. Okay.
I do wonder if we'll actually see that more from government, actually, because we've seen in other procurements, focus on local content, on apprenticeships, on Indigenous participation. I wonder if we'll actually see a shift to more explicit and specific requirements in relation to sustainability. Of course, they've always been there have been there to a certain degree, but I wonder if we will see those sort of come more and more to the fore in future processes.
Yeah, and maybe just picking up, maybe it's not so much in the risk profile, but maybe in the requirements. There is definitely an increased requirement in terms of what we're seeing in projects. So it's more of the requirements of processes that we're going in, as opposed to the risk profile that comes out of it.
Okay. No, I think you're right. It's a topic we could have a whole session on, and it was one of those things we did have a day forum scheduled to talk about the business of climate change, but we've had to sort of rescope that out, perhaps in smaller sessions, so to get that going. But I think it's definitely our members and the market still wanting to talk about it and get things done. We are coming up to time, but I just want to throw a final question to you both. And we've talked about the critical role that infrastructure plays in the economy and where we want the economy to be over the coming months. And we've got the economic blueprint from the chief economist. We've got work done by the productivity commissioner. There's a lot of examining and reporting, and I always think this is a great time for reform, and that is definitely one of the things the state government has said. It's not just about recovery, it's about reform. So thinking about infrastructure, whether it's in your specific area or not, maybe we can get what's one thing that you would recommend the government does differently to either fast track infrastructure, deliver better outcomes, to de-risk. Maybe looking at you first, Simon, and I know you've got a long you can talk on that one too, but it's what's one thing do you think needs change?
And I'll answer it in a funny way, not focusing too much on the change.
Okay.
I think that the key thing at the moment is what we really need is infrastructure has been a really stabilising force, and it can be a stabilising force. I think what we need is certainty. Certainty of the pipeline, not just that there is a pipeline, but certainty of the procurement model that we're coming out, certainty of the timing, certainty of the scope, and then enabling of the private sector to find innovative solutions within that. And so enable us to find the innovative solutions rather than forcing innovative structures.
Yeah.
So I suppose my plea would be certainty and a focus and enabling of innovation in the technical rather than innovative procurement models.
Yeah.
Look, I would say that we've certainly seen a marked increase in dialogue with with the private sector, specifically in New South Wales, around around procurement models and methodology and the state of the market, and so I would just encourage that to continue. I think that's been valuable, and although it may not be producing necessarily the outcomes from a procurement perspective that that Simon or Pacific are necessarily focused on, I think that's absolutely to be sort of applauded and encouraged, to find ways for the private sector more generally, but specifically also, private finance to play a role, because on some of these new models of procurement that are being discussed, that remains actually quite unclear. So I think from our perspective, just that ongoing willingness and ability to engage is really important.
I do want to thank you both very much for coming in today. It's been fantastic, Simon, Marie, to have you here as our expert panelists. It is coming up, you mentioned Transurban, to talk about some of that is a massive project, to talk about how some of that's been delivered and collaborating with government, which is happening in both of your areas as well. But appreciate your time very much, so thank you. I want to thank everybody else as well for joining us online, and also thank you to Procurement Australia for being our partners today. Signing off today, and look forward to seeing everybody on the 31st for infrastructure, or for some of the other forums we've got coming up. I think we've got one on smart infrastructure with Dominello as well as the Minister responsible for that charge. So there's plenty of things to keep you occupied and keep you thinking. So thank you everybody, and take care.